So I have a lot of clients, and some of them may be on the line, but I have many clients who will come to me and they are planning for their or they're working along with me and their aging parents. And they'll have a lot of questions for me about long-term care insurance, or does it make sense to create this type of estate plan if we want to qualify for Medicaid down the line? Or is it too late to put any long-term care insurance in place? And I always want to ask you about that. So I'm glad I can do that now.
Sure. So first, let's talk about the difference between Medicare, Medicaid, and what long-term care insurance actually is. So Medicare is something that's age-based. You reach a certain age or disability status, and you're eligible for Medicare, regardless of financial status. Medicaid is needs-based. So you have to either be impoverished or impoverish yourself before you are eligible for Medicaid. So a lot of the things that people underestimate when it comes to someone becoming older are the costs that are associated with that process, right? It's like such and such needs help around the home, or they need to go to a facility, and you find out that a facility that's just clean, maybe not even the nicest facility, is $3 or $4 or $5,000 a month. And the next step is, if we can't afford it, maybe we can apply for Medicaid. And if you're not working with a financial advisor or an estate planning attorney, you see people take these steps that they think will make it easier to become eligible or have their parents become eligible for Medicaid. One of the things that they will do, because Medicaid requires you to have a certain amount of assets or less, is they'll try to transfer assets from their parents' name into their name. You can't do that. There's a look back period where Medicaid will say, hey, within the past 5 years, any transfers from this person who's applying to a child or someone of that nature is still considered a part of their estate. So they have to spin down those assets or sell them outside of the estate and use those funds for their care before they're eligible. In most cases, and it can vary by states, Medicaid, in order to be eligible, that person can have a house, a car, and in most states, $2,000 to $5,000. That's it. If they have a pension, it has to be spent towards their care. Any investment accounts have to be spent towards their care. What long-term care insurance does is it comes and it puts a fence around those assets so you can keep more before you apply for Medicaid. So, for example, if you have a qualified long-term care insurance policy and there's all these metrics that you have to hit for it to be qualified, you may have a policy that in total provides $100,000 worth of benefits towards things like in-home health care, towards things like an adult daycare facility or a long-term care facility. So if I have a policy that covers $100,000 and I blow through the proceeds of that policy, I spend it all. Now I can apply for Medicaid, and instead of a house, a car, and $2,000, I can keep a house, a car, and $102,000. They have put a fence around all of the assets that I tried to protect by having a long-term care insurance policy. So it puts you in a position where hopefully your family doesn't need it, but if they need it and they blow through it, you don't lose all recourse in terms of saying, oh man, we had this inheritance, however big or small we may think it is, but we lost it all because we had to get care for my mother or my father or my aunt or my uncle. So if your parents are in good enough health to qualify, and even if the family can split the cost to get them even basic coverage, you are putting a fence around those assets in terms of preserving the asset and their Medicaid eligibility.